Welcome again to my YouTube channel, Accounting Basics Academy. My name is Maureen. This is the second video since starting this, opening this channel. I was an accounting tutor for years in college in the United Kingdom. So be rest assured that you're listening to someone who knows what she's talking about. In this lesson, we are looking at the basic principles of double entry bookkeeping. What you will learn the three principles. I call them guidelines of double entry bookkeeping. The guidelines of double entry bookkeeping, we have here the dual effect principle, meaning double effect, double impact principle, the separate entity principle, and the accounting equation. So I'll be going in sequence to explain these. First of all, the dual effect principle. This says that for every transaction there is two financial effects, two financial impact. For example, if you spend £2,000 on a car and pay for it with a check, the impact one, or effect number one, you have less 2,000 in the bank. Effect number two, you have acquired an asset. You have received, you bought an asset, which is a car worth £2,000. Another example of dual or double effect principle. If you're owing a creditor £100 and you send him a check for that amount, effect number one, you owe £100 less than before. Effect number two, you have now £100 less, in the bank, because it is from the bank you took the money. The next principle is the separate entity principle. This means for accounting purposes, the owner of a business is a separate entity or a person from the business itself. That is why when you pay in capital or you introduce capital into your business, the business owes you that capital amount, because it is considered as the business is different from you. This means that the money which the owner has paid into the business has to be accounted for as an amount the business owes back to the owner. That is a separate entity principle. You are separated from your business. Now, continuing with that, also it means that when the owner withdraws money from the business, it will be treated as drawings, which reduces the initial capital that is owed to the owner. When the business takes the goods they are selling for their own use, we consider it as drawing. You're drawing down on your capital, and if it is a cash, you're drawing down on your initial capital. So meaning the business now owes the owner of the business less amount. For more, like as you can see here, you can see some link, for a comprehensive course on bookkeeping. You might as well go to www.udemy.com/course/how to do bookkeeping for beginners, theory and practical. You get many hours of lessons on this course. There is a referral code here which you need to use in order to engage with that course. Okay, so the next principle here is the accounting equation. This principle states that assets equal to liabilities. If the owner's capital, which is the contribution, is treated as a special form of liability obligation, the accounting equation becomes assets equal to liabilities plus capital. When you rearrange this equation, it will be assets minus liabilities equal to the capital. Yeah? Profit usually will increase the owner's capital, and drawings will usually reduce the owner's capital. So the equation can then be rewritten as assets minus liabilities equal to capital plus profit, capital plus profit minus drawings. So what increases the capital is profit. What reduces the capital is drawings. In conclusion, please subscribe to this channel and hit the notification bell for more of accounting and bookkeeping basics. Leave comments. The next video will be on ledger accounting. If you have any question, do not hesitate to leave it in the comment section. Thank you for listening.